is Friday. Sorry, not Friday. Sorry, Sunday. Today's Sunday. And today is the day that I usually do market structure on Sundays before taking trades for the following week. And this is my way of preparing for the week, guys. So, first thing I'm going to do is I'm going to look at the pairs I usually trade. And what I'll do is I'll check all the time frames, like the daily, right here. We have some obvious structure right here. We look at the daily chart on the NAS 100, and we take off this fucking auto. We have higher highs, higher lows, lower highs, higher lows. So look, currently, and it's also, here's a tip. If you guys are doing market structure, select the line chart because that'll just make it so much easier. So what you can do is select the line chart from your Forex candles here by going on the upper top bar in the middle where you see candles, those icons, switch it to the line chart. Then take your line tool and you can take that and let that be your structure. We're only going to mark up the significant structure. So the structure that's maintaining this shape. So we have a high, low, high, low. And these are the biggest pieces of structure that are maintaining structure as a whole. And if we go here and switch it back to our candle chart, our market structure lines are made. Okay. And if you notice here, guess what I see? You want to notice something I see? I see a gap. And if you know, and if you're familiar with my trading style, I only trade supply and demand. I trade gaps. I only trade gaps and order blocks. Those are my only two setups that we trade, and I trade in my group are gaps and order blocks. So one gap is right here. So the gap would be the imbalance that price gets the imbalance that happens when there's volatility. So whenever there's volatility, you'll see the market either impulse upwards or impulse downwards. And when that happens, there will be what's called an imbalance, because a balanced market is up, down, up, down, up, down, up, down. But when there's volatility, it's extremely down, up, extremely down, up, extremely down. And what that means is because there's so much price movement, there often are gaps that haven't been filled that need to be filled to balance out the market, guys. So do you see what I'm saying? So these gaps right here, the gap for this would be right here from wick, from the last wick from the impulse, which was down here. If you guys look in the middle of the screen, that's the candle that the impulse started. And that yellow box that I just drew, if you look at the gap. So look at the candle that the arrow's pointing first, and look at that little wick. So these are candles for a reason. So I'm going to draw the yellow box right here at the top of that candle. And there's usually a wick here, but this candle there isn't. So we're going to draw the box from that top of the candle, right there where the arrow is pointing, the top part of the candle, all the way until the next wick, which is right there. That's the next wick, guys, right there. Okay, and so that's where our box is filled to. And now what you're going to do is you're going to take out the line tool, now that we have our gap box, and that space, it's like a math. The space, the area, the space in here, this is the gap itself. This is the space of the gap, the area of the gap. And so, sorry, what we're going to do is now we're going to take a line, and I call it my gap line, and we're going to mark it right at the middle of the box, so where it's even. You see how I'm dividing the box in half with my crosser? And you see how the box is that gray dotted line dividing the box in half? We're going to take our line, and we're going to go like this. Okay? Now, we just marked the box imbalance gap. Okay, do you see what I'm saying? So that's the people will think when you're trading these that price will have to come back down and bounce off of the top of the box. But what we're trading and entering is that black line, because price will often come down and fill at a minimum to the black line or all the way to the wick. Price will never really come to here and go up. And even if it does do that, That's not what we even trade. We don't even enter there. We wait for it to continue doing what it's doing, and then we wait for a correction for it to come back down to hit our gray line, to hit our our black line. And so that would be our entry. And our stop loss, if we were trading this actual candle, can either be two places, depending on whether you can afford it based on the parameters in my Discord. So your stop loss can be that line I just drew, the red line. It can be right there, or it can be there. Okay? And that depends on if you have enough room in your stop loss. But most of the times, if you can afford it, your stop loss can be either here or here. So the gap is where inefficient price action has not been filled, and we need it to be filled for the market to balance itself out, guys, because there was volatility here that didn't get balanced. So now, if you look at here at the top of the market on NAS 100, you can notice that we didn't really quite break the high here. This candle, the white candle right here, came up, but it didn't finish breaking that high. This black candle, we had a wick that tested it, but it never actually broke. It never actually broke this high with candle bodies. The candle bodies never came and broke the high, just the wicks. So what we need to do is, I'm guessing, this is not a fact, that price could potentially, since there's US dollar news, since we have US news this week, Tuesday, price could potentially come down on a lower time frame and break and come back down past these lows and back to this yellow box. So if we go into the time frame, what I would do is confirm what I just said. I would go on to the 4 hour, and you see how the 4 hour is, we have lows that break new highs. So on the 4 hour, we have this low right there that broke up. We have this low, and we have this low back here. So what we can see right here, see, it's actually much more clear on the 4 hour. If we zoom out on the 4 hour, what do you see? Look at all this inefficient price action that hasn't been filled right here. Sorry, this is an arrow. The red line, this is an arrow. All this price action that hasn't been filled. So what I'm going to do is I'm going to draw a couple of things. I'm either going to draw, I'm going to draw a trend line, because I know traders are trading that trend line that don't trade smart money, and they're going to try to buy off of that. Now, what will likely happen if I'm correct, smart money, if they are indeed going to bring the market down past the red line to the yellow box, I'm going to wait until I see a break on this red line, until it breaks the body of this candle here. And once that happens, I can wait for a retracement, and I can hopefully get into a trade all the way down to the yellow box before buying back up. And so that's just something that I usually will do on a normal. And I know it looks confusing, but it's not, guys. Trust me. Here's UJ, UCAD. Okay, so on UCAD, you see those gray lines? Ignore that mess in the middle of the screen. Just focus on the gray lines. So the gray lines represent market structure. Okay? It represents market structure, and we had a previous trend of bullish trend. We had higher highs, higher lows, because we had a high here, one high here, from that was birthed from one low. And we had a previous lower high, and we had a previous lower low. So in total, we have 1, 2, 3, 4 pieces of market structure confirming that it was a bullish trend. Now, since this is a break on the 4 hour, we could possibly get a trend change. If this was on a lower time frame, like the 15-minute or the 1 hour, maybe not the 1 hour, but the 30-minute or something else, price could still continue to go up and be a bullish trend. But since this is on the 4 hour, what I'm going to probably do is I'm going to wait for price to come to the top before going back down. And what I could do is go on the 15-minute, and I can potentially get into buys before selling at the top right there. So if you look closely here on the 15-minute time frame towards the top of the high, you see all that imbalance. That imbalance at the top of the range that you're looking at was likely created from news. So when there was volatile news, we had all of this supply drop down, right? And that was not balanced. That was inefficient price action. So price never got balanced out here. So the market eventually has to come back to these areas because that's how the market works. It goes up, down, up, down. The market never just goes straight. So eventually the market will return all the way back up to that, especially because we have that confluence on the 4-hour of the 4-hour breaking structure. So what we're going to do right now is I'm going to go ahead and I'm going to mark that imbalance gap right here on the 15-minute time frame. And how I do that is ignore the gaps at the top. Ignore those gray boxes at the top. I'm going to mark the wick first. So the wick I'm going to mark first is this. And that's the gap. Yep. And now all I have to do is wait for price to come to these areas before trading. I hope you guys liked the video. Peace.